There are three tax traps quietly written into Canadian law that strip retirees of their OAS, sometimes a portion, sometimes every single dollar of it. None of them are illegal. None of them are even hidden. They're sitting right there in the tax code. But almost no one explains them to you in plain English. And by the time most retirees figure them out, they've already lost $10, $15, sometimes $20,000 of OAS they could have kept. So today, I want to walk you through all three. No jargon, no fear-mongering, just what I wish someone had told my own parents. A quick word about why I'm making this video, and then we'll get into it. I worked at the CRA before I started doing this full-time. I'm not going to tell my whole story today. That's for another video. But I will say this. I saw a lot of retirees come through that system. Good people, careful savers, people who did everything right. And the thing that broke my heart, over and over, was how often they paid taxes they didn't actually owe. Not because they cheated, not because they were careless, but because nobody had ever sat them down and explained how Canadian tax law treats retirement income differently from working income. So that's what we're doing today. 3 traps. I'll tell you exactly what each one is, how to spot if it's happening to you, and the legal, simple fix. By the end of this video, you should have a real plan, not a panic. Let's start with trap number 1. This is the one that catches almost everyone. It's officially called the Old Age Security Recovery Tax. Most people just call it the OAS Clawback. And I'll be honest, the math behind it is more punishing than most retirees realize. Here's how it works. Once your net income crosses a certain threshold, for 2026, that's around the $93,000 mark, the CRA starts taking back your old age security at 15 cents on every dollar above that line. Not as a separate bill. They just quietly reduce your monthly OAS deposits in the next benefit year. And here's the part that hurts. That 15% recovery tax sits on top of your regular income tax. So if you're already paying federal and provincial tax of around 30% on a dollar of RRIF income, then add the 15% OAS clawback on top. You're losing 45 cents on every dollar. In some provinces, the combined marginal rate inside the clawback zone reaches 50, even 55% on retirement income. And once your income reaches roughly $150,000, your entire OAS, which is around $9,000 a year for one person, close to $18,000 for a couple, is gone. Just gone. Let me give you a real example. A retiree, age 73, takes a $15,000 RRIF withdrawal in November to help his daughter with a down payment. A loving thing to do. But that $15,000 pushed his income from $85,000 to $100,000. Suddenly, in the next benefit year, the CRA claws back over $1,000 of OAS. Add the income tax on the withdrawal itself, and that $15,000 gift effectively cost him closer to $19,000. Most retirees never connect those dots. They just notice their next OAS deposits are smaller and assume the government changed something. So what do? 3 things, and they're all simple. First, use your TFSA strategically. Withdrawals from a tax-free savings account do not count as income. Not for tax, not for OAS clawback, not for any benefit calculation. So in years when you're close to the clawback threshold, the smart move is to take from your TFSA, not your RRIF. Most retirees draw from their RRIF first because they're saving the TFSA for later. That's exactly backwards once you're in the clawback zone. Second, split your eligible pension income with your spouse. Up to 50% of your RRIF income after you turn 65 can legally be reported on your spouse's tax return instead of yours. If your spouse has a lower income, this can keep both of you under the clawback threshold and protect both OAS checks. It's done with one form, Form T-1032, filed jointly with your tax returns. Nearly half of eligible Canadian couples don't bother to file it. They're leaving real money on the table every year. Third, and this is the most powerful, plan your RRSP withdrawals before age 71, not after. The years between retiring and turning 71 are the most valuable tax planning years of your life. If you can deliberately draw down your RRSP during those low-income years, you reduce the amount you'll be forced to pull out later when it can trigger the clawback. Just being aware of that line is half the battle. That's trap one. Now, let's talk about the second one. I'd call it the meanest of the three, because by the time you find out about it, it's already too late to fix. Here's something most Canadians don't know about how OAS works. Service Canada doesn't look at your current income to determine your OAS payments. They look at your most recent filed tax return. So your OAS payments from July of one year through June of the next are based on the tax return you filed earlier that year. Which means your 2025 income, the bonus you took, the property you sold, the company shares you cashed out, determines your OAS deposits from July 2026 all the way through June 2027. I call this the Lookback trap, because by the time you see the smaller deposit, the income that triggered it is already filed, already assessed, already locked in. You cannot go back and change it. Imagine this. You retire at 68. In your last full year of work, you sold some company stock to fund retirement, plus you got a bonus, plus you had several months of regular salary. Your income that year was $140,000, much higher than normal. You file your taxes in April. Life moves on. A year later, you're fully retired. Your income has dropped to $50,000. You're well below the clawback threshold. You're feeling good. And then, the following July, your OAS deposit comes in much smaller than expected. Why? Because Service Canada is looking at the tax return from your last working year, the one with the company stock and the bonus, to set your OAS for the next 12 months. This is what makes the look-back trap so cruel. The other traps, you can plan around them. This one, by the time you notice, is already costing you. But here's the fix that almost nobody knows about. If you've had a major life event that lowered your income, retiring, losing a spouse, leaving a business, going from full-time to part-time, you can file something called Form ISP 3008. It's officially the Statement of Estimated Income, and what it tells Service Canada is this: my last tax return doesn't reflect my current reality. They will then base your OAS payments on your projected current year income, not your old return. Most retirees have never heard of this form. It exists, it's free to file, and if you've recently retired, it could put hundreds, sometimes thousands of dollars back into your monthly OAS deposits while you wait for your tax records to catch up. The other thing you can do, and this is important, is plan the timing of your retirement around this lag. If you're going to have one final high-income year, selling a property, taking a final bonus, cashing out company shares, try to do it the year before you start collecting OAS, not after. A bit of timing can save you years of clawback. Now to the third trap. This is the one that costs Canadian retirees the most over a lifetime, and it's the one almost nobody plans for until it's too late. When you turn 71, the CRA forces you to convert your RRSP into a RRIF, a Registered Retirement Income Fund, by December 31st of that year. From that point on, you must withdraw a minimum percentage every single year, whether you need the money or not. The reason is simple. All those years you were saving in your RRSP, you got a tax break. The CRA has been waiting very patiently to collect what you owe. The mandatory RRIF withdrawal is how they collect. Here's where the trap is. Your RRIF withdrawal gets added to your other income for the year, which means it can push you up into a higher tax bracket. It can push you over the OAS clawback threshold from Trap 1, and the income it generates today becomes the income that determines your OAS the following benefit year, which is the trap from Trap 2. So this single forced withdrawal can trigger all three OAS losses at the same time. Worse, the minimum percentage you're forced to withdraw goes up every single year. At 72, the minimum is around 5.4%. By 85, it's over 10%. By 95, the CRA forces you to pull out 20% of whatever's left in your RRIF every year. Now I'm going to give you the fix that I genuinely wish more people knew about. Actually, 3 fixes, because this trap has 3 legal countermoves, and almost no one uses all of them. The first is the spousal age election. When you set up your RRIF, you can elect to use your younger spouse's age, not your own, to calculate your mandatory minimum withdrawal. If your spouse is 5 years younger, this can permanently reduce your forced withdrawal by 20 to 30% for the rest of your life. You have to elect this before you take your first RRIF withdrawal, so don't wait. The second is pension income splitting. Same one we mentioned earlier. After you turn 65, RRIF withdrawals become eligible pension income. You can shift up to 50% of those withdrawals onto your spouse's tax return. T1032. One form, joint signature. It's the single most powerful tool in the Canadian tax system for retired couples, and it costs nothing to use. The third is donating securities in kind. If you own appreciated stocks, ETFs, or mutual funds in a non-registered account and you give to charity, transfer the securities directly to the charity instead of selling them and donating cash. The capital gains are eliminated entirely. You still get the full donation tax credit. Most retirees who give to their church, their alma mater, a hospital, they donate cash. They could be donating securities and saving thousands. That paperwork, the spousal age election, the T1032, the in-kind donation receipt, the ISP 3008 from Trap 2, that's the difference between a retirement that quietly bleeds OAS and one that doesn't. So those are the 3. Let me put them together for you because they're connected. The OAS clawback is triggered by your net income today. The lookback trap means your past high-income year keeps punishing you long after that year is over. And the mandatory RRIF withdrawal forces your income up whether you want it or not, which feeds the clawback the following year. Which means, and this is the real insight, the most powerful thing you can do as a Canadian retiree is manage your taxable income year by year, deliberately.